Well, hello and welcome to this afternoon's PRISM webinar, Monitoring Your Allocation, Progress, and Life Stages, presented by Charles Rotblut, creator of the PRISM Wealth-Building Process. My name is Jenna Brashear, your host this afternoon, and we want to thank you all for attending and are excited to showcase the final step of the PRISM process. I do want to preface tonight's presentation by reminding our viewers that AAII is a nonprofit educational group and is not a financial advisor and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And if you have questions for Charles or I, please feel free to send them in via your GoToWebinar control panel, which is located on the right-hand side of your screen. And if you experience any issues with the audio or video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And a handout of the presentation is available after the broadcast, and you'll be able to access that later tomorrow afternoon on the YouTube channel as well. And a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts, as well as any resources that we discuss, such as worksheets and things like that. And for new viewers, we always like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And additionally, if you're new to the PRISM process and Academy, we want to give you a little bit of information and background. The PRISM Wealth-Building Process is a 5-step course that provides investors with a framework for aligning their investment decisions with their goals. And following the 5 steps of PRISM empowers you to create a personalized investment plan, and also gives you the confidence to follow it. And after the presentation, if you want to join the online PRISM Academy, you can visit aaii.com/learningplan to get started and see a full syllabus of the program. And the PRISM Academy is a free added benefit for all AAII members. And as I mentioned before, today's webinar is an interactive event. Therefore, we will be answering questions as well as polling the audience on various topics throughout the broadcast. So feel free to submit any questions or comments anytime during the presentation. So without further ado, sit back, relax, and enjoy today's presentation. The floor is yours, Charles.
Thanks, Jenna. And you can see my screen, right?
Yep.
Okay, great. I can't tell what people can see on the other end. So and this is proof to the audience that we are doing this live.
Exactly.
But thanks everyone for joining us. Hopefully the weather is cooler than it is here in Chicago, where summer is in full force. But we're going to try and keep things nice and cool here by talking about PRISM, and more specifically, really getting to the process of how you track your portfolio and track your progress towards your goals. And in front of me, I have here the PRISM, and we have 5 steps. And step 5, we're actually going here at the very bottom of the chart, which is basically monitoring your allocation, monitoring your progress, and monitoring your life stages. And this is an iterative process. So you don't go through step 1, 2, 3, 4, 5, wash your hands, say, okay, I'm done. I never need to look at this again. PRISM is meant to be an ongoing process. So when you go through all steps, you get to step 5. Step 5 is really almost your maintenance mode, where you're monitoring your portfolio, and then you're looking to see, has something changed that would cause you to go back to the other steps and make adjustments. So I'm going to walk you through each of the 3 parts of step 5, and also explain some of the logic as to why we included certain things in the worksheet, and why we're asking you to monitor certain things, so you have a greater understanding of how we came up with this step, why, and also the why, because I think it'll make more sense to you, and you'll start to really see the value of this step, and hopefully it adds value to your overall PRISM process. And for those of you who are new, PRISM really is an ongoing plan, really an ongoing process, and process is a better word, to aligning your investment decisions with your goals. So it really is about tying all the decisions you make with your portfolio and having those go to your goals. So and how those help you achieve your goals. So let's get to the worksheets here, and I have everything blown up a bit so it's easier for you all to see. And first of all, we're going to start off with monitoring your allocation. And obviously, as we record this today, The major indexes are down quite a bit. I believe the S&P 500 was down about 3% just before we started the webinar. So obviously monitoring your allocation is somewhat timely as we record it. But the whole idea about monitoring your allocation is really thinking about how your portfolio should be allocated in an ideal sense, and then checking the way it is now and seeing, do those two things line up? And so just to backtrack a little bit, if we go back to really the second step of PRISM, which is R, recognizing your allocation, we ask you to list what your allocation is for a given goal. And so we do give you our asset allocation models at AAII.com. We have an aggressive investor allocation, a moderate investor allocation, and a conservative investor allocation. And those are included in this worksheet, as you can see. Now, if you're looking at those and you're thinking, yeah, those are interesting, but they're not quite right for me, that's fine. You can enter in your own customized portfolio allocation. So perhaps you really want a huge allocation to small cap stocks. Maybe you don't want any bonds. Maybe you have commodities or cryptocurrency in your portfolio. That's fine. Whatever the target allocation is for you, given your tolerance for risk and given the time frame until your goals are, we want you to write it down. And so this worksheet really serves as your target allocation. So once you do this, what you want to do going forward is periodically check your portfolio and see whether or not your allocation matches your target. So what we did on this worksheet, that's part of step 5M of monitoring, is we ask you to take a look at, first of all, jot down what your target allocation is. How much should you have allocated to each asset class? And that really goes back to step 2, the recognizing your allocation, which I just showed you. So whatever you put on this worksheet, whatever you said, this is my allocation, whether it's you're following, sorry, not trying to scroll too fast to get anybody dizzy, but is it one of our model allocations? Or is it an allocation that you listed as your customized allocation? Whichever that is, that should go in here where the target allocation is. The current allocation is what is your portfolio's allocation on the day you're looking at it. So if you're looking at it today, you'd put down that basic breakpoint of how much you have in large cap stocks, how much you have in small cap, etc. And then the difference simply is, what's the difference? So if you say you have 15% right now on large cap, not 115, we're not going to assume you're leveraged, and your target allocation is 20, then your difference is, okay, so your allocation now is 5 percentage points off target. Now, is that good? Is that bad? Well, that depends on what you consider to be an acceptable range of variability. So you could say, personally, I use 5 percentage point bands for my own 403B plan, my retirement plan at work. And that is based on Vanguard. They've done research into rebalancing, and they say to rebalance, basically taking your portfolio and bringing it back to your target allocation. They say to use percentage bands of 5 to 10%. Now, those are guidelines, and they're good guidelines, but you can change those guidelines to what you see fit. Perhaps you want a tighter range of variability. Perhaps you want a wider range of variability. There is a school of thought that says how much you should allow a given asset class to veer from your target should be dependent on that asset class's volatility. So commodities, for instance, are a lot more volatile than, say, bonds or stocks. So you could adjust those bands. And I think the big thing here is to realize there isn't a single right or wrong answer. The 5 to 10 percentage point band is just a guideline, and it's a good guideline, but you're not required to follow it. But whatever that variance is, allow your portfolio to move within that boundary. So say, for instance, I have this 5 percentage point band, and I look at my portfolio today and I find out the large cap stocks are 18% of my total allocation. Well, this difference of 2% means it's within that acceptable range of variability. And the one thing I will say when it comes to allocation is realize investing is messy. If you try to always have your portfolio at your target allocation, you're going to drive yourself nuts and you're going to have way too many transactions. Plus, if you allow your portfolio to veer from your target allocation, you get to take advantage of short-term momentum, meaning the asset classes in your portfolio that are doing the best, you're giving them a chance to continue to run, to continue to realize that outperformance. The goal with rebalancing or just plain monitoring your portfolios is to make sure that they don't become too overweight. So say, for instance, if mid-cap stocks become too overweight, that can change the volatility of your portfolio, and it might make it riskier than you desire. So how often should you be looking at this worksheet? Vanguard suggests annual or semi-annually. When we built PRISM, we suggested doing it annually, but again, that's a guideline. You can just look at your portfolio saying once per year, and that's pretty acceptable. Now, if you have big market moves like we are having right now, excuse me, a potential spam coming through on my computer, don't think I'm going to answer that. But going back, so if you have a market conditions like we have right now, where the S&P 500 has entered a bear market, the NASDAQ and Russell are down about 30%. In those situations, you might have, sorry, I keep getting messages here. So in those situations, if you have the market down 20 to 30%, you might want to say in your rules, you know what, I'm going to look at my portfolio if the market's down this range, and if it is, I might seek to rebalance, in this case, perhaps increasing your allocation to stocks, therefore to try and buy them when they're down. You can do that. I would say it's just running it down, and I would also suggest having set rules. But the other thing, and this is a very big thing, if you're going to use a market downturn to look at what your allocations are, make sure that you have the emotional ability to look at to see your balance and not react to it. Because if you're heavily allocated to stocks, or you have a significant allocation to stocks, I can tell you your portfolio is likely way off where it was pre-bear market. And obviously in this current environment, we're also seeing bond yields rise, which means bond prices are down. And so that portion of your portfolio is probably off. That's part of investing. We have these short-term variability, these short-term drops, but we get rewarded over the long term by following a disciplined approach. So just keep those in mind, but you can do it. But I would encourage you to write down when you'll look at your portfolio, when you'll engage, and then how you'll rebalance. Now, let's get into that conversation about rebalancing here for a second. So say you see your allocations and they're off your target, and you want to move them back into target. How do you do it? Well, there's a few ways. One, you can rebalance, which basically means if stocks are overweight and bonds are underweight, or conversely, bonds are underweight and stocks are overweight. To use a very simple example, bonds are overweight and stocks are underweight. To give you a very simple example, then you could perhaps sell some of your bonds and use it to buy stocks. So selling the asset that's over allocated and putting the proceeds into the assets that are under allocated. If you're taking withdrawals, and some of you might be retired and taking withdrawals right now, you can look at your asset classes that are most overweight and pull money out of those asset classes to help fund your withdrawals. If you're saving for retirement or another goal and you're still contributing to your accounts, then you could steer those new contributions towards your underweighted assets. But keep in mind, the higher wealth is, and more specifically, the greater the size of your portfolio is relative to what you're contributing in terms of new savings or relative to what you're withdrawing in terms of withdrawals, that may not be enough. You may have to do periodic rebalancing. And again, use those bands of variability, and also consider what the appropriate frequency for you is. And PRISM, again, we suggest looking once per year. You can adjust that, as I said, to have a frequency that's right for you, but keep in mind, I wouldn't do it too frequently because then you'll just start transacting unnecessarily, and you might cost yourself the advantages of some short-term momentum by allowing your portfolio to veer a little bit off target. Jenna, before I go on, are there any questions that have popped up?
Let me check out. Let's see. Not yet. So would you like to do a poll right now, or?
Yeah, let's do the poll. That'd be great.
Okay. We'll do the, we wanted to ask the, our members, do you have a clear portfolio monitoring process in place? So let me go grab that. So feel free to vote in our poll, and just to get an idea, if you have a portfolio monitoring in place currently, or so that would be yes. And if no, if you're even still thinking about it but you haven't developed one yet, then go ahead and click no. Then I'll give a few minutes for everybody to vote, and then we'll share the responses.
Sure. And while we're doing this, I'll just talk about the market while we're doing the poll. We're obviously having a reaction to the Fed raising rates by 3/4 of a point yesterday. And I'll talk about a lot more. You'll see it tonight in my investor update email. If you're not getting it, you can just go to AAII.com/investor update. But the Fed's clearly reacting to the rise in inflation. They clearly got it wrong in thinking inflation was transitory, and now I think we're seeing a repricing in the markets, and the markets are trying to obviously figure out how much interest rates are going to rise. But I think also there's a concern about that the Fed, if it's too aggressive, it could cause a recession. So we have those factors going on. If you're a saver, the one upside of all this is you'll probably see higher rates being paid on your savings accounts and on your CDs. And if you hold bonds and you have a bond ladder, you'll get the chance to roll over that bond ladder, or roll over, if you have a CD ladder, into higher yielding investments. But it'll be up later this afternoon. I encourage you to read it. I go into a lot more detail about the Fed's rate hikes and kind of looking at how their forecasts are evolving, and give some observations about what it means for stocks and bonds.
Right now.
And for those of you watching this after the fact, I'll just point out it'll be in the archives of Investor Update as well.
And it looks like 67% said no, and 33% said yes, they do have a clear monitoring process. So that's great to see.
Yes, absolutely. And thanks for participating. I will say that just having a monitoring process is really beneficial when you look at monitoring your portfolio. And it doesn't have to be extremely formal, but just having a process that when I look at my portfolio, I'm going to do X, Y, and Z. There's a lot of research showing that even having a simple checklist helps considerably, and it works in a variety of fields, not just investing, healthcare, aviation, even rock concerts. Van Halen used to specify in their contracts that no green M&Ms be in the dish, and the reason why was that they saw those there. It was assigned to them that the concert venue wasn't following the terms of the contract, and therefore they should check their whole setup to make sure everything was done correctly. So even it's a very simple checklist that kind of guides your monitoring process, it'll help greatly. Obviously, we have tools here in PRISM, particularly here in the monitoring step. And so I do encourage you to consider using them and see if that does not help you make better decisions. So now I'm going to jump over to monitoring your life stages, and we'll get to monitoring your progress in a moment. But I want to go to monitoring your life stages, so we just stay on the Adobe Acrobat documents at one time. So this really is the second part is, so after you've done your allocation, we want you to know, not us, but you to stop and consider, has anything happened in your life that might cause you to reassess your risk or reassess your goals? And putting this together, we really try to think about what major life events could people have that might impact their financial plans and might impact their investing goals and their allocation and their risk tolerance. And so we try to actually make this as comprehensive as we could. And so one of the things you'll see on here is family. Has there been a change in your family? Has there been something positive like a birth, or perhaps, you or one of your children got married? Has there been something negative, a divorce, a separation, a death? Any of those things can change your financial plans. It can also affect your estate plan. So a simple checklist here. Yes, this has happened. No, it hasn't happened. We're asking you, does this change impact your goals? If so, you want to go back to the first step of PRISM P, which is prioritizing your goals, and reprioritize your goals and figure out what your goals should be going forward. But we also, you'll notice here at the very end, we put things on here asking whether it impacts your will, your insurance, other estate documents, and does it change a beneficiary? So the reason why is, as you go through this, don't only think about, hey, I've had this life change and it's going to affect this goal, or it's going to check my risk tolerance in this way. It's also a good time to just ask yourself, oh, you know what? I don't have my son's new wife listed as a beneficiary, or I don't have her on a will. I should talk to my estate attorney. Or perhaps, you have someone who is a beneficiary who unfortunately passed away. You may want to update your documents like that. Or perhaps your children, turn age 18 or 21. And at that point, maybe you want to have them listed as a secondary beneficiary to your spouse or significant other. So as much as this is about monitoring your life and from the standpoint of, does it change your allocation or does it change your goals, we also want you to use it as an annual checklist to think about, are all my estate documents and are all my beneficiary information and all those small things that have a huge difference as to whether or not my finances are set the way they want to from a estate planning perspective. We want you to use this. So we turn this into a helpful checklist. We also ask about change in health. Obviously, if health worsens, that could change your risk tolerance, that can change your goals. That's why we're asking that. Obviously the flip side is, had someone been seriously ill and they got better, which is obviously the desirable outcome, that might change your goals as well. But at the same time, going back to your documents, you have a beneficiary who's seriously ill. You may want to revisit how your brokerage statements are set up and perhaps add a secondary beneficiary should the one event you don't want to have happen happens. So again, having that checklist. And employment, a new job, a loss of job, a change in compensation, or even retirement, that can impact your risk tolerance. And it might be a reason to go back to step 2 and maybe go back through our risk questionnaire. So we have it right here, the recognizing your risk. This is part of step 2R, recognizing your risk. And so if you do have a change in compensation, it would be a good sign for you to actually perhaps go back through it and consider, hey, you know what, maybe I can tolerate more volatility in my portfolio, or maybe it's the opposite. Maybe I need to steer back how much risk I'm taking with my portfolio. And you see this going through. Housing, if you bought or sold, you downsized, you moved to a more expensive residence. If you moved into a retirement community, that would affect your cash flow, because if you've been living in a house that's paid off and perhaps you moved into a Brookdale independent living facility, or maybe you moved into assisted living facility, suddenly you have this monthly outflow of cash to cover that, and that could affect your risk tolerance. And obviously change in wealth. Maybe you inherited money, maybe your portfolio returns are better than you thought, or they're worse, or perhaps there's some other inflow of capital. Maybe you bought a business, or perhaps something happened that's a negative. You had some really expensive repairs and some high medical bills, and all of a sudden, maybe that alters which goals you can achieve. So just trying to think about those types of things. But again, we also have this note about your state documents. So if you have a large influx of wealth, that might impact your will, what you're giving to certain people. And maybe it brings in, some goal that you didn't think about before to be attainable. Perhaps all of a sudden now you realize, you know what, I have enough to take care of my heirs, but I can also get to my congregation. or there's this charity I'm really passionate about, I can give to them. So as you go through this, again, it's not just how does it affect your finances, but think about how does it affect also your estate planning as well. And it's good to do this once per year. The start of the year is a great time, or even actually if you do it in late December, something might pop in your head that you might think, oh, you know what? If I do this right now, if I make this big charitable donation, if I take this loss now, it'll help me on taxes. So it's a good end of year, beginning of year practice to go through. What I would suggest is calendarize it. Circle a date on your calendar, and it can be whatever date works for you, but circle on your calendar once a year, just go through this exercise. And obviously, if something happens between then, you can obviously go through this document at this point when you've had a life stage event that's happened, perhaps next month. You're blessed with a new child into your family. You certainly can do it at that point, but just having that date once a year is a good reminder for you to go through this. And again, it not only affects your PRISM process and your financial plans, but it also has implications for your estate plans as well. And by making sure you keep this information updated, the time when you really need to have those documents updated, where it really matters that they're updated, and it will already be done. Now, on the back side of this, we also included an inventory of key estate planning. And this is really an addendum to the PRISM process. But the reason why I have this on here, and it actually goes back several years ago, my father-in-law, he was diagnosed with a serious disease, and I actually walked around his house one day with him. I literally had a notebook in hand, and we'll walk around the house, and I asked him, where are your documents located? And he said, well, he knew the filing system. Well, I have some in this drawer, and some in this filing cabinet, and he knew, this is a safe deposit box. He knew where everything was. My wife and I didn't. And so when he passed, instead of us having to go through this fishing expedition trying to figure out where things were, I put up my notebook and I knew exactly where the will was, where the house title was, where his military ID was. I was able to quickly get that information, and it was extremely helpful that next day after he passed, when I had to sit down with my mother-in-law and help her get control and help her take those next steps to get balls running, to know exactly where everything is, what he had, and walk through it. So that's the backstory behind this. And this is really a personal checklist for you to actually fill out and give to your heirs. And we've tried to think about all the important estate planning documents, who you work with, what doctors you work with, if you have life insurance policies, if you have pensions, wills, documents, where they're at, if you want to put beneficiary information on there, digital assets. And so this is really a checklist for you to maintain and to share with your family, the people you want to step in and take over when you need them to, when the unfortunate thing happens. And again, good idea just to update this once a year. This is something that's very personal. We don't expect you to share with other members of the community, but of AI community, but we do ask you to consider actually filling this out and having a discussion with your heirs. And again, how much you fill out and how much you actually do, really, how much of this you actually use is up to you, but I think it's a really helpful document to have. And the other thing I will point out about both of these documents, both what has happened in your life stage as estate planning document, is those of you who work with a professional, whether it's a financial planner, with an estate attorney, perhaps an accountant. If you have these documents updated once per year, when you sit down and have those annual conversations with them, you can bring these documents with them and go over them. I think it'll help you have a better conversation. And in fact, I would encourage you to fill out the whole PRISM process, all 5 steps, and bring the whole PRISM plan with you, particularly if you're working with an advisor, because I think you'll have a better conversation with your advisor or planner, because those of you who do work with one, and we know about 30% of AI members do, you'll be able to sit down with them and say, this is my PRISM plan, this is my wealth building plan, here are my goals, here's how I perceive my risk, here's how I perceive my investment preferences. In this case, here's what's going on with my life. I think you'll find you'll have a better conversation. And if your advisor or your planner doesn't want to look at PRISM, that's in your documents and have that conversation with you, that's a sure sign that you need to find another planner or another advisor, because a truly good advisor and truly good planner will be very happy to see this and they'll want to have that conversation with you. So again, we've really built PRISM for you to really help you out. Jenna, before we go on to monitoring your progress, I think we have a poll coming up, and also if there's any questions I can answer.
Yeah, let me pull up the poll about beneficiary information. Here we go. Go ahead. And so we're asking, when was the last time you checked your, your beneficiary information in your accounts, like we just talked about? Has it been within the last 12 months, within the last 1 to 2 years, or more than 1 to 2 years, or even longer? So go ahead and feel free to, participate in the poll. And I don't know if we have any questions yet. Just remember, ask questions about any kinds of, the worksheets that we're going through. If you have any questions about, how using, PRISM cyclically, or, how going back to, step 1 after you completed step 5, or, anything about, the PRISM community itself, lessons or things like that, we're happy to answer.
Absolutely. And like I said, as I said earlier, PRISM is an ongoing process. So you see these documents, I talk about checking them once a year. And we really intend these documents to be a living documents. In fact, all PRISM, it's a living process. So if you fill out PRISM worksheet, any of the worksheets we have and something changes, update the worksheet. This is not a one-time and you're done again. This is really a process that we want you to keep using and updating, because we think it will really help you make better decisions. And I think it will empower you as an investor as well.
Excellent. So it looks like about 62% voted. So we're going to close it right now. I'll share the results. So it looks like 67% within the last 12 said within the last 12 months, 11% said within the last 1 to 2 years, and 22% said more than 1 to 2 years or longer.
Well, that's great that 2/3 of you all have done that. It's a good rule of thumb to check once per year. I do it myself usually at the start of the year. Those of you who have gone more than 1 or 2 years, it often doesn't take that long, but it's a good idea just to check it. And you don't have to do it right away, but like I said, just put it in your calendar and just make sure that information is correct. And we've seen all sorts of lawsuits over the years where people have problems. Sorry, I get messages flying across my screen about dinner tonight with the boys, but I've seen several lawsuits where estates have been settled not in the way perhaps the deceased intended, because they didn't have their beneficiary information updated, or perhaps they didn't have a certain document updated. For instance, there's one lawsuit I saw years ago where someone passed, he got divorced, but there was one document from the divorce that he never signed and gave to his employer, and because of that, the ex-spouse got all the 401k versus the woman he remarried didn't get a penny because that one document wasn't filled out. So obviously, for those of you married, we're hoping you stay married and everything's great, but it's just a good example about how important it is to make sure that beneficiary information is updated constantly, because little small things can really have a huge implication for having, in terms of whether or not your estate is executed in the way you desire. And obviously, all of us at AI hope that all of you are immortal and you won't have to worry about estate planning. But just in case you're not, it's a good idea to have those ducks in a row. So let's go on to monitoring your progress. And so we're going to skip from the PDFs to an Excel spreadsheet. Those of you who read Jim Clunen's book, Investing at Level 3, and use some of the tools, have seen a version of this. We actually use it as our basis. So we have 3 tabs on here. I'm starting right here. This is a single goal calculator. And what this basically is, it allows you to determine whether or not you're on track for a goal. So all these cells in yellow are changeable. We just threw in some default assumptions. They may be very applicable to you. Your numbers might be really different. That's fine. So, if you're looking at this, you're saying, well, actually, my portfolio value is $500,000. You can plug in $500,000. If you think your annual rate of return, you think, you know what, I'm gonna get some really high returns. I'm gonna put in 12%, and my goal is 25 years away. You can change those numbers any way you want, just whatever you want to be. So what we have for default options are just default options. So don't get hung up on those numbers. We had to plug in something to use this. And we actually have the same sheet without any values if you choose. But what the goal is basically is how much do you have saved? How much are you going to save? What's your rate of return? And then how much you actually have, accumulated at the start of your goal. So, if someone who's young, just out of college, their goal might be zero. Now, someone who's retiring, maybe they're right now retiring this year, maybe they have $1 million saved, and right there we can actually assume, before goal, since they're retiring now, we can plug in a zero there and 0 years to retiring now. And so all of a sudden we're seeing here where the accumulated wealth at the start of the goal is $1 million. So you can change it to whatever it is. Now, then you go down here, the second part is your withdrawal period. So how long are you going to spend on your goal? So if you're working, you can type in 0 and you'll have 0 withdrawals. But say you just retired and maybe you're looking at 30 years of retirement. And then the question is, on your withdrawal phase, how much do you expect to earn on your retirement portfolio? We could say you're perhaps hoping to earn 7%. And again, this number can be whatever you want. And then your annual withdrawal, whatever the number is, again, maybe you want to withdraw $45,000 per year. Again, it's up to you. You can change those numbers to whatever you want. This worst case withdrawal, this worst case drawdown number, this is the largest drop you think your portfolio will have given historical market conditions. And so this 38% is actually based on the 2008-2009 financial crisis. I'm going to jump around here for a second. So I mentioned our asset allocation models before, and so this is at AAI.com/asset-allocation. If you scroll towards the bottom of this, we actually tell you how each portfolio, are aggressive, are moderate, and our conservative portfolio, how they performed in a bad year, how much downside you can reasonably expect, barring an extreme event like the Great Depression. So that's why we have 38%. Now you can change that number. Maybe you think your worst case scenario for your portfolio is going to be greater than 38%. Maybe you think it's going to be less. Again, you can change that number to whatever you want. If you want it to be 20, you can change it to 20. Well, what this does is assuming, and right now I'm showing you assuming you're making withdrawals, what this does is assuming what your portfolio should be getting based on your rate of return for a given year, you can say, okay, at year 6, based on my assumptions, my portfolio should have a value of about $1.16 million. In a worst case scenario, my portfolio might drop to about $900,000. Now, if your portfolio is within this range and the market's down, you can tell yourself, I'm still on track because I realize this is within the range of variability. The market's down, it'll come back. Now, if you're saving for a goal and you're below that $925,000 level, then you might need to take action. Maybe you need to consider, reducing the size of your withdrawals if you're taking money out of your portfolio. If you're saving, maybe you need to increase your savings rate or perhaps consider pushing back your goal. And obviously, if you're way off in your saving, then you may want to consider whether or not the goal is achievable. Now, if you're retired and your balance is well below the worst case drawdown, then unfortunately you have to start thinking about things such as going back to work, whether or not how much you can really tell on your budget on your, how much you can restrict your spending, or perhaps you really might have to just, in that situation, realize that you're going to struggle. And obviously we hope no one gets on that scenario, but usually the idea of having this spreadsheet is to realize you're off track before you get to that point of no return. So you realize that okay, my portfolio is off track. I need to do something. I don't need to do something. And that's a whole rationale for having this spreadsheet. It's really to give you a gauge of how close are you to being on track or off track. And if you're off track by too much, then you know you need to do something. Now, and that's particularly the case if you're below that worst case drawdown. Now let's go to the opposite side. You look at your ending value. Instead of having $1.6 million in year 6, you have $1.7 million, or whatever the number is. You're way ahead of your goal. That's a great situation to be in. And in that case, you can assess whether or not you want to spend more on your goal, whether you want to build up a bigger rainy day fund, or if you want to start looking at your aspirational goals. And there isn't really a set number where we say that you're above this ending value, you're safe, but you should realize that the market's doing really well. You probably want to allow for an upper buffer above that number. And whether it's 10%, 20%, it's your call, but you may want to have a certain level where you say, okay, I'm above, but I also owe the market, so I'm not going to go too hog wild with that excess. And in retirement spending, and this works really well with goal setting too, there's something known as a floor and ceiling approach, meaning that if you're taking withdrawals, you're allowing your withdrawals to actually rise to a certain level if your portfolio is doing well, but not above that level. And that number can be variable, but it can be the same thing here. If you look at funding goals and you look at aspirational goals, maybe you say, I'm not going to fund aspirational goals until my portfolio is at least 10 or 20% above that ending value. So, or perhaps a little bit more. If you think your portfolio is more volatile, you consider that. So kind of using that band of ranges for it. Now, for people who want something that's a little bit simpler, we have a scenario calculator. And this basically is a future value calculator. So if you have, if you have a certain amount saved, and you have a certain goal you want to reach, you can see, okay, there are other assumptions. If I start with X amount of dollars, and I assume Y rate of return, and Z years until the goal is reached, and maybe you consider all of A level of income and B level savings rate, you can use this to tell you exactly, okay, how much I'll have at the time I reach my goal. And you can see here, we have some default assumptions about whether or not, how much you'll actually have the date you have to start funding your goals. And all these numbers in yellow, these are just default assumptions. You can change them to whatever you want. Now, if you're retired and you're concerned about withdrawals, it's the same type of thing. You can make assumptions about how many years you're going to do withdrawals, what type of rate of return you're going to make, and also what withdrawal you're going to actually take. Now, these lines in blue actually I'll click on this, actually come from that. They're actually, I believe, tied to our single goal calculator as well, your withdrawal rate. So you can actually change things on this. What I will say, if you're comfortable with Excel, you can actually customize this sheets. And obviously of the single goal calculator, like I said, we have a blank value. You can actually, revise this to make it suit your needs. We only went out 25 years. You can go longer. But the idea is to give you a simple spreadsheet that you can use if you're comfortable with Excel to tell you whether or not you're on track or you're off track. Now, if you're looking at this and going, the thought of using Excel makes me cringe, that's fine. There are various retirement calculators out there. On last month's AAII journal, we took a look at several. You can use those, or even better yet, you can just go on Excel, type in future value calculation. That's future value calculation. Type that into Google. There's various future value calculators where you can run some simple numbers without having to do Excel. The nice thing about Excel is it allows you to do some customizations based on your savings rate, based on how much you have saved, or if you're withdrawing, to change your withdrawal rate. So either way, it's a good idea just to have some range as to, okay, my savings should be at X point on Y date. And is it within an acceptable range of volatility of whatever that target number is? And if it is, you're good. If it's too far beyond whatever you view as an acceptable band to be at that case, then You might want to consider making changes to your portfolio or making changes to your savings, or perhaps deciding whether or not the goal is attainable, or perhaps you do have to just work more or find other ways of earning more or tightening your budget. There's always something you can do up to a point. And if you realize your goal is just not attainable and it's a goal that you can do without, then maybe you have to make that hard decision to let that goal go. As I said, unfortunately, some goals, such as funding retirement, are non-negotiable. And hopefully no one's in that situation where they reach retirement and they have to really consider make some hard choices. Our goal is to empower everybody not to get to that point. Jenna, any questions?
Yeah, actually, so let's see, we have, Robert, he was asking, can the spreadsheet handle RMD withdrawals that change annually?
It actually can, and so you want to customize it, but you can actually use this spreadsheet as a framework. The annual withdrawals right now is just actually a hard value on this, so you could actually take the RMD, use the RMD spreadsheets from the IRS. You probably want to create a separate column, but you could actually have your RMDs, estimated RMDs, updated every year if you wanted to. So yeah, it would take a little tweaking, but you absolutely could do that.
I think that's up right now. Right now, I've been fielding a couple questions just about where to find the worksheets and everything. So I just wanted to kind of reiterate that if you haven't seen the comments to the questions, that if you can find all of our worksheets in the PRISM Academy library. I've linked it in the chat and then also in the question section. So if you have any problems, getting into that section, it's labeled the library, but also there's a direct link to both of those worksheets. You can always email members@AAII.com, and they're happy to help you, get to those worksheets and make sure that you're logging into your AAI account and able to get into the PRISM Academy.
And I'll add real quick, Jenna. Also on our planning page, we actually have it right here where we say the PRISM Wealth Building Process Toolbox. If you click on this link right here, that'll also give you the 5 worksheets as well. But in the library, we have more resources in the PRISM Academy library, including some guidance from Jenna and myself throughout this.
Exactly. Thank you for showing that. That was really helpful.
Mm-hmm. Any other questions?
Not right now. I think we've answered all of them. But yeah, feel free for anybody who has any questions. Continue adding them, and we'll answer the best at best we can.
Absolutely.
We do have another poll. Do you want me to do the final poll, Charles?
Yeah, well, that'd be great.
Awesome. So this one, we are asking, during this year's bout of downward market volatility that we're experiencing right now, have you taken a look at your portfolio? So, I mean, just, share with us, take some time to answer the poll and let us know if you have taken a look, or if you're someone who's, trying to reduce that risk tolerance and psychological risk, and that you're kind of setting aside and you're not looking at it for the time being. So very interested to hear, actually.
Yeah, absolutely. And what I will say is, people are doing this, just a general, guidance here. If you find yourself being really nervous about the market, tune out. Don't go to CNBC. Don't look at Yahoo Finance. Go outside, go for a walk, spend time with friends, or if you have a pet. Obviously they always appreciate the attention. But you know what? It's sometimes the best thing you can do when the market's down is just not to do anything at all, and not, and do whatever it takes to get your nerves down. The danger always is whenever we have a drop like this, that someone acts out of emotions instead of according to a disciplined plan, and that's usually has bad long-term outcomes.
Exactly. I'm going to close it right now, and I will share the results. Looks like a lot of people, about 94% have said yes, they do. They have taken a look at their portfolio, and it's about 6% said no.
Okay, great. And like I said, hopefully those of you who've looked at your portfolio, you've done so in a disciplined process, and you've made, I'll say, non-emotional decisions in doing it. And it's always easier said than done. I realize that's really the key is to, you know, when you look at your portfolio, have a disciplined way to do this. And one of the things I'll share, and I actually put this on Twitter the other day, was guys from Jack Bogle. I got a chance to talk to him twice, actually more than that, but he once told me that, you know, if someone's starting early for savings, they shouldn't look at their portfolio for 30 or 40 years. And then when they do look, Jack advised having a doctor nearby in case they faint, because they'll be that shocked when they see the value of their portfolio, how large it's become. And while I certainly don't expect people to go 30 or 40 years without looking at their portfolio, I do think it's helpful to realize that investing is a long run game. And whereas Mr. Market's very short-term focus, and our advantage of individual investors is to invest according to our goals, and not the short-term focus that we see so often talked about in various outlets. All right, Jenna, if there's no other, I don't know if there's any other questions. If there's no other questions, you want to talk about the upcoming webinars?
Yeah, no, it looks like yeah, we don't have any questions right now, but of course I want to reiterate that, you know, if they think of something, you know, you can always go into the PRISM Academy and go ahead and, you know, comment. Oh, we actually have one right now that just came in. Let's see.
Right.
So from Mark, he says, you know, recently retired, but now working as a part-time consultant, interested in planning Roth conversions and understanding all the ramifications concerning taxes, Medicare premiums, etc. Is there any tools at AAII for optimizing this process, including the PRISM Academy?
Yeah, so Roth conversions, we do have some articles about Roth IRAs. We can put those in the show notes. I am actually working on a dedicated retirement page. I'll have those linked. What I'll say about Roth, whenever you have a downturn like we're having right now, that is the ideal time to do a Roth IRA conversion. And it always drives me nuts that you don't see more people show up on TV or on the media saying, do a Roth IRA conversion, because the IRS taxes you on the dollar value of what you convert, not the number of shares. So for the same tax bite, you can convert more shares. So now it's an ideal time to do it. But as you're doing it, you want to consider two things. One, your ordinary tax bracket. So you don't want to convert so much that you get bumped into a higher tax bracket. But you also want to consider the implications for Social Security taxes this year. And then if you're taking Medicare, and I presume if you're recently retired, you probably are, what your income, what your adjusted MAGI income is right now for this year affects the Medicare premiums you'll pay 2 years down the road. So yeah, obviously you have to make assumptions for what your income will be 2 years, you know, what your Medicare, the brackets will be 2 years down the row, but you want to kind of use that, take those assumptions in consideration. So it's always probably a lot of times better to do incrementally than all at once. Unless you're really to say, you know, 1 year I'll take the hit on Medicare premiums because this is the year where I have other deductions, my tax rate's low. I'd rather do it once. A lot of times it is more beneficial to spread it out. So it very much is a math game. It very much is a forecasting game to try and figure out how converting X amount per year will impact taxes in future years. But we'll include some articles to Roth IRA conversions in the show notes.
Let's see. And then we also have some articles. I know Charles has put a lot of time and thought into, you know, some articles that, you know, when I actually linked in the chat, but using PRISM for investing in retirement, we have a couple other articles that are really specifically PRISM in retirement. So you can always find those on our website, and then we'll link them also in the resources when we upload it to YouTube as well.
Absolutely.
We had a question, do we have a Roth conversion calculator for us, or do you know of one that does really well or you've used in the past?
You know, we don't have one. I have not looked for one. That's a good question. I'll jot it down. We might take a look around and maybe perhaps do an article about it. We did an article on retirement calculators. I'll make a note of it. No promises. You might want to do you might want to do an online search. I don't know if there is one out there or one that's good. I would think there's one out there, but I honestly don't know, but it's a good suggestion and
It
something we
is.
may consider for a future article.
Yes, thank you. I appreciate that.
Yes.
Looks like we're about I think wrapping up. And like I said, if you have any other questions, for us, you can always email us at members@aaii.com, and we'll be happy to answer any questions you have. But yeah, I just wanted a big thank you to Charles for delving into how to develop a consistent and clear portfolio monitoring process to make sure that we're on track for achieving our financial goals. Charles, do you have any lasting thoughts before I jump into upcoming webinars?
Yeah, I'll just say one thing. Like I said before, PRISM is an ongoing process. So step 5 is something we monitoring, something we actually encourage people to do. Once per year, just go through this process. I think once you start doing it, after the first time, it'll get a lot easier, and I think you will find it really beneficial. And even some of the estate planning stuff we included, fill that out. I think, and have those discussions with your family. I think they'll really appreciate you going through that effort.
Exactly. And I do want to mention real quick that lessons 1 through 6 of monitoring your allocation progress and life stages have all been released online and can be accessed via the community platform. We have the interactive worksheet as well as the spreadsheet that Charles showed us. And you can use to accurately plan for future adjustments. And you can find both of these worksheets as well as participate in the lessons within the online PRISM Academy community. So you can visit aaii.com/learn-and-plan to enroll in the online PRISM Academy if you haven't already. And for the upcoming webinars, we have 2 actually that are coming up in the next couple of weeks. So we have the Individual Investors Show, Sizzling Stock Opportunities, which will debut on Thursday, June 23rd at 4:30 p.m. Central. And for this II show, we chat with Derek Hageman and Matt Markowski about their articles in the June issue of the AAII Journal. You'll learn how to make sure a high-yielding dividend stock is a quality company and not one with weak growth prospects. You'll learn how to effectively evaluate a company's ability to increase its dividend payment, as well as how to best use stock screens and techniques to build a strong portfolio. And then we also have a new series that is coming up. This will be the first of our new series, which is a rebroadcast of chapter events. We have numerous chapters across the nation. I think over 30 that bring quality speakers to their chapter meetings. So we wanted to highlight a few of those, especially ones that really shine. So our first event will be equity-like returns with bond-like volatility. Is it possible? That will debut on Wednesday, June 29th at 7:30 p.m. Central. This was originally hosted by the AAII New York City chapter. This presentation with Rob Bernstein covers the different stages of the business cycle, specific tools to help you navigate through the next bear market, as well as how to enhance your ability to achieve equity-like returns on bond-like validity. And as always, to view and register for upcoming webinars or other events, visit aaii.com/webinars. And I want to thank everyone for attending tonight's webinar. Lastly, I wanted to mention again that this presentation was recorded, and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to these presentations, resources, or anything else we discuss. And before we do wrap up, I want to reiterate that you can join the online PRISM Academy, countless special interest groups, also known as SIGs, on various investment topics such as retirement withdrawals, income investing, allocation strategies, and so much more. And then as well as your local AAII chapters, all on our online community. So visit community.aaii.com and log into your AAII account to get started. So yeah, with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you and take care.